Good morning, everyone. Welcome to our 72nd market outlook for the month of July 2026. We are in conversation with Mr. Praveen Bhalerao, Managing Partner, Pranitya Wealth LLP. Sir, first question to you. How do you see the Indian situation post the peace talks?
Yeah, this peace talk which took place on 17th of June, we go back to the last outlook of ours where we have said three, four things and fortunately they have come true. The first was the Trump will find the graceful exit from this whole episode. Second was the oil as feared may not go that much and will remain under control as we speak. We are below $70 in terms of crude. And third was like the Indian market. People feared will go down to very weird levels, but we said that it should hold 22,800 to 25,500 range.
Yes.
And if oil goes to 70, we said it will be at 24,500, and exactly we turned from there. And as we speak, we are at 23,800 or 23,900. So cooling off war has already taught India a lot of things. We diverted our oil resources from Venezuela, US, Russia. We've been, the oil basket was costing $123 at the peak. Now it's brought down again significantly, and the threat of long oil prices remaining very long time is gone. So now we focus is back on the monsoon, and I think quarter one results for this season. So I think situation is not that bad as expected in,
Right, sir.
in the earlier part of the month.
Thank you. Sir, my next question would be, has macroeconomic situation in India improved?
I think we need to discuss a lot of points to come to that conclusion as where we stand, and we have a habit of connecting dots. There are about 10 to 11 pointers where we check where the economy stands. So we start with the GST collection, which is prime and important.
Yes.
Like last month of April, we saw huge collection of 2.43 lakh crores. Now it has gone to 1.96 lakh crores in the month of May, mainly coming from the imported goods where we charge GST and all. I think something goes to the extra GST on gold and silver imports, which was levied in the month of June to help the BOP situation. That also added to the GST collection, and it's quite a healthy situation. I believe the compliance part and also the collection and the consumption has helped GST to remain at an elevated level in spite of we had done a lot of reshuffling in terms of GST rates in the recent past. So this is looking healthy. 6% year-on-year rise for first 2 months bode well considering the current market situation, the US trade tariff and all that.
Yes.
I think we are not we are in line with the expectation.
True, sir.
Second could be the IIP growth. I think the latest data which came in yesterday for the month of May at 5.1%. April was 4.9% and current month is about 5.1%, driven by electricity generation, the manufacturing, sectors which contributed to the IIP growth is very encouraging.
True.
So power generation, these are all capex, power generation, they are all manufacturing sector which contributed to the IIP data after a really long time, except for small contraction in mining, otherwise consumer durable, non-durable, and the household consumption, everything is showing positive trend. That is very positive. Then the corporate earnings I will go to, which is quarter 4 numbers. They are really encouraging. One must note after 12 quarters of sub 10% growth. So we never grown for last 3 years in terms of corporate earnings more than 10%. So we saw 12% PAT growth and 15% PAT growth and 12.5% sales growth for this quarter 4, which has come really quite ahead of expectation, and we PAT remains, but average 5 years growth was about only 11.3%. Important to note, Nifty 50 share in this whole growth has dropped 49%. So what it means, the growth is broader. It is not concentrated only top 50 companies. Actually, there is a degrowth there, and we say large cap the growth is a challenge all large caps are growing sub 10%. So
True.
it has come broadly. So mid cap, small caps has grown much faster, and it is seen in the prices of these stocks.
Correct.
Next point could be the bank growth. So I am trying to connect all these dots,
Yes.
where and that's help us to form a view on the market. So bank growth came at around, credit growth has come about 17%. There is uptick month on month in terms of bank growth. And deposit growth is about 11.4%, which is fine. And this whole growth of bank credit has come diversified manner. Last quarter, it was only personal loans which contributed a lot to the bank borrowing. Now it is MSME, SME and personal consumption and corporates all put together. We can see there is a good traction I can see for capex, and which can be seen correlated with the other factors going ahead. Next will be the direct tax collection. So this last year we in 26 we collected 23.4 lakh crores of tax, and next year government has kept 15% additional target, that is about 26.5 lakh crores.
Yeah.
I think it is achievable. There was a doubt and there was a question mark when we started with the Q1 numbers or
Yes.
Q1 quarter. But as we see oil coming down, I think we have good chance of recovering next 3 quarters and reach that number if the corporate profitability come to rescue. Because last year it was mainly the personal tax which contributed more than the corporate tax. Corporate growth was slightly lower than the expected. Second, coming back to the inflation, the CPI inflation first time rose to about 3.93% in May, thanks to the food inflation of 4.78%.
Yes.
Monsoon could be oil and everything indirectly contributed to the food inflation. The WPI number is at 9.68%, which is again driven by crude and petroleum prices. And the revised projection for FY 27 by Government of India will be about 5.1%, which was earlier 4.6%. So we will have some kind of a twin risk of inflation. So WPI going up because of the petrol prices and CPI
Yes.
going up because of food inflation. So RBI is in dichotomy. I don't know what they are going to do in the month August. At least June they held on to the rates, but August 6th is the next meeting of MPC. So RBI will decide by that time how the inflation trajectory moves, and then the further rate hike or not rate hike depends on that. But inflation is a worry as such. Capex situation, there was a nice report came in recently on 20th of June in Business Standard, the Business Line, which talks about the entire capex story for India.
Yeah.
The last 10 years, 2017 to 2026, the overall capex in India has grown by only 9%. This is private capex I am talking about.
Yeah.
So, and government capex in last 1 year has gone up by 26%. So, government is actually doing the heavy lifting. So, if
Right.
India wants to grow at 7% plus, we need this number to be around 11 to 12%. That's what the statistics says. So 9% private capex is not really going to help.
Help us.
But recent numbers, which government has talked about the scrapping policy for electronic scooters and vehicles, that is there. Then we have NIIF, that is National Investment and Infrastructure Fund, which was earlier 30,000 crores. Yesterday they added another 30,000 crores to that. So government is actually committing more, looking at the shortfall from the private sector to cope up with this infrastructure spend. So
True.
this NIIF will be able to spend about 60,000 crores on infrastructure and in development projects. So that indirectly lead to the capex and the other sectors to grow, and so naturally government is doing the heavy lifting at this stage. Then the GDP, if you see, is not fallen. So the last year we done 7.8%. Of course, the revised estimate for the current year has gone down to 6.6 from World Bank. Government of India is also saying same thing. RBI governor is of the different view. We feel we will grow more than this number, but all goes with the where the oil is, where the monsoon is.
True.
And how the first quarter goes by. The expectation from first quarter is not that great. but eventually we'll have to see. It's very early stage that we are talking about the GDP growth, but even 6.5% with the background what we had last year of war, the trade agreement which is still in the negotiation stage with US, I think this bode well. So we are a bit positive about GDP, and that helps even earnings to grow. BOP situation, I still feel is in a not a great situation, except for the last month, which came positive surprise. The trade surplus was 7.1% for quarter 4, which is about 0.7% of GDP.
Right.
Thanks to the exports and Gulf remittances, I think, because of Gulf situation, people shifted a lot of money back to India, considering that trade. But even today, will be about in terms of trade deficit, will be 2% of GDP. So that means about $50-60 billion of shortfall we'll have, and that is how the government, like we spoke about, government has to do something on the BOP situation. We talked about BOP a lot in the June outlook.
Yes.
So the government has taken some steps, and FCNRB is one more, and waiving the capital gain on foreign debt investment was another. And of course, there are some other measures like you can't hold back your foreign earnings for more than 3 months instead of 6 months. All that will help eventually to get the dollars back in the country, and this particular ECB thing is expected to generate $30-40 billion when we spoke to the bankers, with leverage, without leverage, because there is some kind of a hedge the government is offering without any cost. So I think that will compensate to a certain extent of this trade deficit, and things can improve from here. And BOP may not be a big threat. That also helps our currency to stabilize. You've seen currency move down from 97, 98 to around 94 and a half type of thing. And that gives also confidence back to the FDI, FI investors to invest back in India. So that also is very positive. Looking at FI activity, for the full year of 25-26, they sold about $1.6 trillion. That's a huge selling they done. But the more selling has happened in the calendar year of 26, which actually exceeded the last year's of sellings, about 2.24 lakh crores. No, sorry, my figure was 1,66,000 crores last year, and this year 2.87 lakh crores, or they already sold till June of this year. The selling is mainly account we discussed, like mainly on BSFI, large caps and all. And this has happened because there is no India dedicated fund. So they sell emerging market funds, and emerging market India is part of it.
Correct.
Though India has been sold a lot, will get sold further if they try and sell emerging markets funds. So FPI of late we have seen them selling been considerably gone down, and on certain occasions they have been buyers in the market. But that is, I feel, no more of it. They sold a lot now, and Indian situation and global opportunities are going down. Actually, they are selling in Taiwan and Korea. We are back to the 5th largest market, dropping South Korea below us.
True.
So all that shows that the major threat from FI selling is over. Coming back to the FDI, which is also important for the rupee and balance of payment situation. The FDI last year gross, it is important to see gross and net.
True, sir.
Net is not the right thing to look at, because when we are investing, I would like to look at persistent investing more than $1 billion outside of India. That is cash assertive or profit assertive. So these are done with certain intent. So keep it separate, keep inward and outward separate, and that's how we can see that last year we got about $80-85 billion of FDI investment, and current year gross is about 90 plus. So that shows there is a good amount of traction. We are able to attract FDI, and if the currency stabilizes, I think that situation can improve. Last year net was hardly $1.1 billion of net FDI, and currently it was $7 billion of net FDI, because we are able to find a lot of opportunities in Germany, best of the engineering company, best of the IT companies. If you are to be ahead of curve in terms of AI, we need to go and acquire than sitting on cash. So all these things will be looked positively. So I will not give more weightage on net FDI, but I will give more weightage on inward FDI.
Cross.
Outward will keep happening because these are opportunities at rate. So one cannot too much control the outward FDI because these are needed. Finally, the money is going to come back. It's our Indian multinational which are investing abroad. So they will add to the Indian GDP at the end of the day. So I'm very happy on the outward FDI if their cash austerity or a profit like is positive in terms of cash flows.
Yeah, yeah.
And the last could be the rupee dollar. Of course, I spoke thanks to RBI scheme. I think FCNR will be successful. This is an old recipe which we are using again and again.
Yes.
And it is all proven. So I'm pretty sure we'll end up with getting 30-40 billion dollars. That will help rupee to stabilize, which was very much required. And last could be the government divestment. So when we are talking about now food subsidy and petrol diesel subsidy and fertilizer, which is critical because of the West Asia war.
Yes.
So that to compensate that we need to really be on top of FDI divestment to recoup the shortfall. I think IDBI Bank, which was fallen out, but I'm pretty sure it will happen in next 1 or 2 months. We have done the IRFC 5% and 2% of we are doing in IRFC and 5% in GIC.
Yes.
I think this year we'll achieve that 60,000-70,000 crores of FDI. Sorry, the government divestment target, and that helps the overall financials. On the last point is very important is the US-India tariff war. So I think that is mostly over. They are given 24th July as a deadline.
Yes.
I think most of the terms have been agreed. There could be tweaking here and there, but I think the exports will be on for sure with 10% or 17%, nobody knows. But that helps India to improve the financials in general. So this is where, if all this point, if you put together, you'll see more positive than negatives.
Correct.
That's what I can say.
True. Sir, considering all these important points that we discussed, how do you see the Indian equities today?
Yeah, of course. We recently there was a sell-off globally and tech sell-off also. So we have gone down along with them. 24,500 could not be achieved. 2400, 200 we touched, and now we have started the downward journey. I think 23,800 will be held. That if you see 2300, we traded about 19.5 times trailing P.
Yes.
Forward could be much better depending on what kind of earnings we see. If we are able to do that 12% or 14%, 15% earning as expected, we definitely look cheaper at this stage.
Okay.
The rally large cap has not really gone up because of the FI selling, but mid cap, small cap has already hit the all-time high. Mid cap index, so this is a broad-based rally. So I am not really questioning the rally which I've seen. Having said that, we are not even touched the previous high of 26,500.
Yes.
Even if you go there from here, so it will be about good 12-13% return coming to you. And within that, if you are smart enough to invest partly in growth mid-cap stocks, return could be quite high. Just look at last 6 months, Nifty is down about 5-6%, I believe, and mid-caps are up 22%.
Yes.
So that shows where the market is. So if you just keep looking at Nifty or a BSE, you'll get completely deceived. So there is a lot of action happening and a lot of positivity in the market. If you really deep down or dig, just to see, we have to talk about the AIF which we have launched, has done phenomenally well. Against, I think I have figured till May 31st or 15th of June.
True.
May 31st, so definitely market was down 4.9%, we are up 7.5%, 7.7%.
Yes.
So 15-16% or 13-14% outperformance is very, very significant if you get the things right. And and if you see the composition of Nifty today, the financial services, information technology, oil and automobiles, FMCG, all put together is about 50-60% of the market.
Right.
If you see the prospect or the growth expected in this sector, we don't feel Nifty will go too much up from current level because there are a lot of headwinds for all these sectors like IT, financial services, and specifically banks. Forget financialization theme, and automobiles is slightly positive. FMCG is negative again with the monsoon and all. So we don't feel there is going to be any fireworks in the market, but reaching to 25,500 is not difficult.
Yeah.
So our base will be bottom up is the best approach in this market.
Yes, sir.
And if you see the PEG basis, again there are very, we can have enough stocks which are attractive at a very attractive PEG level than PE level. So PE will be very deceptive to base on. So PE is the best right way of looking at the market. So it's glass half empty, half full, you can say today.
True, sir. So coming back to the economic situation, do you see any challenges for the India growth story?
Yeah, I think most of the challenges of late has come from outside of India. And if today also what we see, there are two, three which come to my mind is first maybe the oil prices. So though the oil prices has crashed from 123 dollar barrel for us to about now 80, which will eventually come down to 70, 72 for sure. Looking at the supply side, constraint, if you are able to overcome that, I think India will be in a blessed situation. Second could be the employment. I think AI will take out a lot of jobs. That's the only threat for me. I see how can we replace so many jobs. Oracle has removed 5,000 people in India. You'll see more. They are definitely not adding, but
Right.
IT is the major major contributor to the employment generation in India. If they are not hiring and actually taking out people, will be a big challenge because we have, I think, about 50 lakh students passing out every year. So getting them into mainstream and job market will be a big challenge. I am not sure exact number, but engineering, medical, at least engineering will be very important to get jobs. Rest, I think, can get absorbed.
Right.
So that's and the monsoon is, I think, we are already 40% short as we speak. But usually in monsoon in India, I'll rather give more weightage post July. What can be what is the shortfall? If it is 90%, 92%. See, dependent on agriculture of Indian economy has gone down significantly over a period
Right.
of time.
Yeah.
If we have enough water and water table is improved, thanks to last 2 years of good monsoon, we have enough water table in the groundwater. The monsoon is at 92% is not a big threat.
Okay.
It's very important to see how the distribution is.
True.
If we get enough rains in the food grain bowl of India,
Yes.
say like Punjab, Haryana, Rajasthan,
Correct.
Maharashtra, Karnataka, Gujarat belt, and Tamil Nadu and Andhra Pradesh, I think we are done.
Okay.
If there is we need to see shortfall in these states,
Yeah.
then on an average overall basis in India.
True.
If you get there, I think, I think I'm not really worried too much about monsoon situation at this stage at least.
Right.
Uh, Energy sufficiency could be one of the big factor which is played out last one we've seen. As we speak, we ready to have over 7-8 days of supply of oil in India, the oil gas which is required for manufacturing. Of course, we have not gone down to a situation where in Singapore and Malaysia and other countries or in Sri Lanka there was outages and stoppages of production, queues on the petrol pumps. I think India handled that situation really well. The diplomatic ties with so many countries, we'll be able to overcome that. And soon now we are shifting to EVs and all. Over a period of time, I think the shift will be from 30% to about say 40, 50, 60%. So if you go down in terms of our oil imports, will be a blessed situation, and I think we are heading there.
Right.
FDI, FPI attraction, I think we are still a lot of challenges. We are not able to attract because of red tapeism. It's not very easy to set up business in India,
Yes.
though we speak single window and double window, whatever it is. But the problem is like we are a long way to go, making things easy. So we
Right.
need to work there. Currency stability, we are still depreciating. Average 2.5% last year was 7%.
Right.
If you really work on the currency part of it, make it more stable for investor to get enough confidence to invest in India. And last could be the suboptimal growth. We have been talking about corporate earnings growth of more than 10%, 15% every year.
Yes.
Barring last quarter, I think last quarter, where we got more than 10% after 12 quarters. So I think we need to work on the manufacturing. The government is putting lot of efforts of pushing manufacturing, and I think we'll find the answer soon.
Right, sir. Something, sir, something which is very interesting and a lot of people are very keen to understand is your view on investing outside India.
See, one need to understand we are living in India, so we have to abide by the rules and what are the opportunities available to us. Yeah, I agree. India is just 3% of the global market today, but what are the ways of investing outside available to you is more important.
Yes.
One is like we spoke about the LRS, where you can open account with any authorized dealer, and there are enough people, players in the gift city. There are Indian brokers, I don't want to take the names, but where you can open your account and invest outside of India, provided you have enough understanding about that market. I doubt
Absolutely.
even 10% of the people understand the foreign market, where they can invest in stocks or funds or ETFs, index fund, and etc. etc. And it's a long-term process. Part of your $250,000 LRS limit, which includes everything, your travel, your remittances, everything put together. And if you have enough family members, you can use that and create some corpus outside of India. Second could be in investing in outbound fund through gift city, because this has been difficult. It is better to go through a fund route. If some good funds are offering there, I think couple of funds offering option to invest into emerging markets or US tech market or a debt market, US equity market type of thing. There will be far and few because government is not encouraging money going out of India in dollar terms.
Right.
So, you will have more, the gift city is more for inbound investment than the outbound investment. But again, that is also subject to LRS limits. Third option is without LRS limit is the Indian funds, where the Indian funds invest into the offshore market through either ETF or through fund of fund route. This is very popular and this is very easier. But today there is a cap of 6 billion for ETFs, a fund of fund, and for ETF it is $1 billion. Both the caps are full, so you cannot use that limit anymore. Having seen all these three options, I doubt anybody can put or push significant amount outside, and we are left with no option but to focus on the Indian market. And again, there is a limit how much you can have of your total portfolio into foreign market, because it requires a lot of understanding and study. So I feel we should be happy investing in India, and 5-10% of money, if you are really want, you can push through the fund of fund route first, and if you understand market directly, then LRS through any of these brokers or international brokers, you can do that.
True, sir. Sir, considering the asset allocation, any view on gold and silver?
Yeah, gold imports have dropped drastically because with the measures now, almost 18.4% you pay on import duty, including the GST when you import gold. So gold imports have dropped 70% last quarter to about 20-30 tons from much higher number before. Silver also is a similar story. So investment interest or speculative interest in gold has gone down considerably, and that is how the prices also have dropped. It may lead to some smuggling and all, I don't know, but there is a big parity between India and now gold available, over 20% arbitrage between gold outside and gold in India. And in long term, see, I don't know how long India this will keep happening. So investing in gold inside silver in India comes with these challenges. Suddenly you will find you are put to at a handicap situation, and in long run 5-10% allocation to gold silver is okay, but the major run up has already happened. If you see gold, silver has run up about 52% in last 5 years average I am saying, and gold has run up about I think about 13.5% for 5 years, 24% for 3 years, and about 13.66% for 10 years, which matches with your equity returns in 10 years time. So always there is a spurt, and then if you see the long term returns will be at par with the equity when my understanding about gold goes. Silver is an exception because it has industrial usage. So silver returns looks bit attractive because of this last 2 years of spurt. But prediction about rates is very difficult. Honestly, no view on gold and import in terms of rates.
Right.
But as an asset allocation, you can have 5 or 10% in your portfolio.
Correct. Correct. So, do you feel this is the right time to invest, or are Indian equities attractive now if we have to invest into the domestic market?
Look, post the FI huge selling and post where we are, like we are at similar level for now almost last 2.5 years. I
Yeah.
think this level was seen somewhere in July of 24, if I am not, August of 24.
Yes.
Now almost we are more than 2 years. Yeah, more than 2 years. We have seen the market not moved anywhere. 24, 30 months almost.
Yes.
So it's a high time. Also, the time correction is already happened. We might have run up too much in that time zone, but now run up has already happened. The valuation has considerably corrected. The earnings has started improving a lot. There are focus of government on engineering, defense, infra, power. Power consumption is at peak. We are 250 gigawatt already crossed. The consumption is investment in power is required. Capex is also picking up eventually because we have started utilizing capacity beyond 70%, 80%. So rebalancing also happens, and there are a lot of foreign companies which is using India as China plus one. That continues. So all that put together, I feel valuation wise, post this correction, we are very attractive. Of course, this is now going to be a bottom up market, not top down. Not all
Right.
sectors will do well. FMCG has their own challenges. But if capex, infra, power, your services sector, the IT, some part, financialization theme, all these sectors, if they do well, I feel there is a opportunity for Indians to invest. With SIP number which is 31,000 crores is a great help to the market. We should not allow it to go down. And this number also will not, I feel it is only going to go up and not coming down. That offers a support to the downside correction when market corrects. But I feel market one should gradually invest. These are good levels, definitely. I'll look at long term. I don't know what happens in quarter one. After quarter one results, there is skepticism. Quarter one is not going to be great, and that's an opportunity. I feel market is still around 23,800. Otherwise, with last quarter's background, we could have already moved beyond 24,500.
Right.
So I feel at current level there is an opportunity, and one should long term investor. It's a great opportunity for sure. I don't know about traders. I don't have any view for that.
Right, sir. Right, sir. So your view on debt market? Do you see it's a time to invest?
See, we completely gone wrong. As we got right as it in the beginning, we completely gone wrong in terms of our expectation on rate hikes.
Yeah.
When oil shot up, we thought we'll have at least see 2 hikes in this year, but the oil has crashed much before, much ahead of expectation.
Yeah.
And that also led to the correction in the 10-year GSEC. So it was 710, and now it crashed to 6.80 as we speak. So I still feel on 3rd of August, RBI will take enough time. We call it a long look at the yields, the inflation, and not react immediately. Could be one hike in this year possible if inflation remains at beyond 5.1 CPI I am talking about. Otherwise, we don't see that hike situation prevails. And if oil really consumption come to an halt and consumption crashes, oil consumption, we might be in a very, very good condition, and yields might even, there's a good chance yield will correct downwards than upwards here on.
Right.
So long term investors can still look at long dated funds, the gilt funds or corporate bond funds. We found out opportunity in terms of SIF, a taxation efficient way of investing in debt, where you put in SIF. There are 2 funds, I think, one from Edelweiss and second from HSBC. We pure debt SIFs, where the investment goes only into debt. So technically, it's a equity fund where we get 12 months and concessional tax of 12.5% type of thing. But one can consider there is no track record, unfortunately. But the strategy or the positioning is very right for investor to look at debt through SIF way.
Sir, to conclude, your thoughts for July 26, what should, as an investor, we look at?
I think, as I told you, this barring monsoon, I think if you get the final verdict as where we stand sometime in July end, by that time we'll have our corporate earnings also out for quarter, most of it. I'm not saying all results. From here till July end or August end will be a good time to accumulate. So one should not jump the gun immediately, but start nibbling, start putting money. Those who are invested, don't do anything, just stay put. I don't see anything negative coming in the long run. For short, fresh money, I think STP is the best approach. Make 3 months STP. If you are too conservative, make it 6 months. But in long run, we will go much ahead in terms of markets and index Nifty. 26,500 will be definitely taken out in a year's time, and that translates into 13-14% of return from now. SIP, STP are ways, of course, everybody
Right.
knows about that. And also look at our AIF, which is a completely bottom of type of approach. We are succeeded in delivering much higher returns than the rest of the even mutual fund and AIFs in that sense. I think things are improving slowly. It's going to be a grind till top, and definitely I am not negative at this stage.
Thank you so much, sir, for your views on the market. Truly appreciate your inputs.
Thank you so much.